If there is anything sadder than spending 25 years at the same desk, it's the accountant who has to calculate the liability for the honoring clock the company promises to give you at the end of it. This part of IAS 19 is particularly annoying because it forces us to care about things that might never happen. We have to run complex actuarial calculations for jubilee benefits. And then there is termination benefits, accounting for the cost of firing people. You would think firing someone is cheap, you just stop paying them. But IAS 19 ensures that even the act of breaking up is expensive and administratively painful. Let's break this down using the bad relationship model. First, other long-term benefits. The anniversary cruise. Imagine you promise your spouse, if we make it to our 20th anniversary without killing each other, I will take you on a world cruise. You are currently in year 3. Most people would say, I will pay for the cruise in year 20. IAS 19 says, no, you are earning 5% of that cruise every year. You must accrue the cost of that cruise now, adjusted for the probability that you get divorced in year 7. You are technically in debt for a vacation you have not taken with a person you might not even like in a decade. Second, termination benefits. The divorce settlement. Now, imagine you decide it's over. You tell your spouse, I am leaving, but here are the house and the dog so you do not sue me. This cost has nothing to do with how long you were married. It has nothing to do with future anniversaries. It is a penalty for hitting the eject button. You do not save up for a divorce settlement while you are happily married. You recognize the cost the moment you decide to leave. Now, let's apply this to the ledger before the auditors arrive. Part A. Other long-term employee benefits. These are benefits not due within 12 months, but they are not pensions. Examples include long service leave, jubilee benefits, long-term disability payments. It is remarkably similar to defined benefit pensions, but with one crucial mercy. Remeasurements go straight to P&L. If your actuary guessed wrong and people lived longer or interest rates changed, you just dump that variance directly into the P&L statement. We do not need to hide the volatility in OCI. Part B. Termination benefits. These are unique. Unlike every other benefit in IAS 19, these are not earned by working. They are triggered by the end of working. You recognize the liability and expense at the earlier of these two dates. 1. When you can no longer withdraw the offer, you have announced the redundancy plan to the staff. You cannot say, just kidding, without a lawsuit or a riot. 2. When you recognize restructuring costs. If you are doing a massive corporate restructure and booked the cost of closing the factory, you must also book the cost of firing the factory workers at the same time. If an employee leaves voluntarily, that is not a termination benefit. That is a post-employment benefit. Termination benefits are only for when we kick them out. Here is your cheat sheet to survive the board meeting. For other long-term benefits, do the math, but don't stress about OCI. If the liability changes, hit the P&L. For termination benefits, timing is everything. Do not accrue for firing people just because you think you might fire them next year. You only book the liability when you have crossed the Rubicon, when the plan is communicated and you cannot back out.